There are so many trading assets, but which one is the right for you? Which one is actually the one where you decide on to make money and literally stay consistent on? Because you can only concentrate on one thing, and they all have advantages and disadvantages, and in this video I'm going to talk about futures trading, how it can benefit you. The first one is that somewhere between Central Time 9 AM to 4 PM you can summer select any time, 1 or 2 hours, and that's already it. Now, there are different kind of trading strategies out there. There are trading strategies where you need to trade maybe for 4 hours or even 5 hours a day, Monday to Fridays. But using this trading strategy that you see here, you only need to use 1 or 2 hours freely somewhere between Monday and Friday, 9 AM to 4 PM Central Time. Can be every 2 weeks, just whenever you're available. And the money-making activity with every trading strategy is when you trade for 1 or 2 hours or like 4 or 5 hours, depends on what the trading strategy is telling you to do, then how many signals can you get? That means if you have a signal, you want also to know, by the way, how good that signal is. That means if you can adjust $100 to make just $300 on average, and there's another trading strategy that you can adjust $100 to make $500 on average, the one trading strategy has a benefit. Like it's just better. If you have one trading strategy where you can just adjust $100 to make $300, but you need to trade 4 hours, and maybe you have like 5 signals or 2 signals a week, but with the other trading strategy, you can just trade 1 hour or 2 hours, and you have 20 signals or like just way more signals. The other trading strategy will be still better because you can still decide what signal to pick. You don't need to rely on just because the book is saying or a coach is saying, here's this line and here's a green candle and now you need to enter the trade. Well, the market is just wiggling around. So what you actually want to see is that you have enough signals that you can see also the personality of the market. That means, do you have a market that is going in a direction for hours? Or do you have a market that is just like staying at one price area for hours? I'm going to show you something on my screen, because that's just from theory going here to the practical execution. And this is the S&P 500 future. If we, for example, go to Swiss franc, for example, it's called GHF, very, very famous currency. We can do it by yen or whatever we like, do it like by yen here, for example. Then this market here, for example, Swiss franc, is very often, you can see here, it also goes here for hours, just like uptrending or downtrending, but very often it just stays in one price area. Swiss franc is very famous for, as you see here, that it just stays in one price area. Like it's a very, very consistent price. If you do CHF to like, let's just say like euro or like, for example, to US dollar, this is something that's very interesting. You should be seeing here, look, now it's not that trending anymore. Now you can see that this currency is pretty stable over the years, right? And this is something what is just not that nice. If you now go to an S&P 500 future, for example, it looks like that. You'll see that this one here is way more trending, way more going to different kind of price areas. Like it doesn't want to go back. Like once it's away, it doesn't want to go back right away. It wants to go to bigger structure lows or bigger structure highs, these are called, right? So instead of now being in the day chart for each candle, because else we need to trade over years, we are going into a 1-minute chart. And in this 1-minute chart, it's very important that you don't just zoom in like that. It's important that you don't zoom in like that. You want to use your full screen on the right side like this. And then you want to zoom out on the bottom that you see all the structure. Like if I can't see here any structure, it's not a big deal. We use the chart like this. If I'm going a bit lower and I can zoom in, I can see here, I want to be max zoom in. And now check this out. On the right side, zoom in now, that I can see here, just use all of my screen here. And what we see now is that price stood over days in this area. That means if you have a trading strategy that tells you to trade in this area, it will be just not working that well. Why? It's because the market shows you very obviously that the market likes to stay in this price area. But once you see that the market is pushing out, I'm going to show you a specific pattern. And this pattern works with a lot of markets. And if you use this with the S&P 500 or the Euro US dollar, it's very efficient. That means you see that the market is here wiggling around, as you see here, wiggling around. And then what you want to see is that when the market goes up, that it's not touching back in. Because if it touches in, it's like a magnet and then the market will just like push back. But when you see it goes above this consolidation phase, it's called, it's not touching for multiple times, then we can assume that it continues going higher. So that means like starting here, you see here the area where it starts with a lot of candles. You just want to catch it with an area around a lot of candles. The more experienced you are, the more accurate you can use these trading zones, but just making it around here in an area. And then you can see starting here on the right side here where the circle is, that the market is not touching this zone here back here. And because it's not touching it, and you can see how the market is literally going up like that, that is called higher lows. You can obviously see that the market likes to go down here to this bigger structure high. The market always likes to go to a bigger structure high or here to a bigger structure low. And you can see then if the market doesn't go above it and now it starts in a consolidation phase. Now check out what happens, by the way. It's doing here a lot of candles. It's doing higher, less candles. And it just shows you that the market wants to go back here to this area. And then you see now here, the market is spiking up and is spiking down, what is very, very dangerous to trade. So what I really love is trading away from these consolidation phases. What you see also then the market tries to go under this low here. Doesn't make it under this low, as you can see here, does more candles, and now wants to go up. That's like a direction method, how to read also the direction. But now check this one out. Here we have the consolidation phase. The market is touching it from the back. That's one of the main reasons why it's dangerous to trade here. But then starting up here, you can see that the market is trying now to go for the bigger structure high. And then when you see here that it stays here in this area, pretty nice, that it moves to a new price area, that's very nice to trade for later on. So the US session will start here in a couple of hours. We still have here a lot of time. And then in the US session, then like trading downwards or trading upwards makes a lot of sense, because you see here the market spent here less time. The market is going for several hours higher with higher lows. As you can see here, the structure is going higher. That's very nice when it comes to trading. And when you just trade here for an hour, that's what I mean with the money making activity, is that let's just take here an hour from like, let's put this one to Central Time. We put here plus, it is minus 5 there. Central Time, and we put here just like a 9 a.m. for example, like around 9 a.m. and we put here like to 10 a.m. for example. Now the thing is, how do we find here signals? And what I just like is are just simple green or red candles. That means just seeing when you see the market does a specific length. That means length from here to here is the same like from here to there, as you can see here. That means when you see the market is wiggling around a bit wigglish within this length, it's important, just because we see here some signals, not to take them. It's important to adapt. That means when we see the market does this length, minimum when the market goes up here and then taking signals up here. And that's something what you see here. You see here up here a red candle. And with a good money adjustment, there's, by the way, a tool using trading. We just try this out. This is a short and a long tool. Really nice. When you understood how a trading signal works with the entry and a stop loss. Look, you just place it there. I like it always above the color switch, exactly where the highest wick is for selling. The entry should be where the red candle closes. There's a timer on the right side. Shows you when there's a countdown. It counts down within like 60 seconds always. And 5 seconds, 2 seconds, as you can see on the top right, very small. It will show you like when the candle is closing. So we enter where the candle is closing. We have the stop loss on this color switch. And then this is the risk reward ratio that you see here. And we put this to 1 to 5 minimum, like this. That means if you have your position sizing adjusted here to $10 in the MES, for example, just around an average, that will be $50 of a winning trade. But if you adjust this in the ES1 exclamation mark to $100, that would be $500. If you adjust this to $300, that would be $1,500 for this winning trade. And by the way, it will be also, when aiming here for this low, you can see here the 1 to 5 is being achieved before the market touches this low. It's more like where the market had here this consolidation phase again. You can see here how the market pushes out and then wants to go back in, where you see here where the market was spending here a lot of time. Hope you learned something. Wish you all love. Good trades. JT out.